Imagine paying off a premium financial protection plan faithfully for 20 long years, only to receive an unexpected official letter on your 75th birthday stating that your annual costs are instantly doubling. If you pay, your fixed retirement budget is completely shattered. But if you walk away, every single dollar you invested over 2 decades completely vanishes into air. This devastating financial dilemma is not an accidental market fluctuation, but a highly calculated actuarial framework known as lapse rate exploitation. Multi-billion-dollar elder care financial systems explicitly design their long-term pricing models around the scientific expectation that a massive percentage of policyholders will voluntarily forfeit coverage. The entire corporate strategy relies on forcing you to surrender your policy right before you ever reach the age of peak medical vulnerability and file a single claim. The structural flaw lies within the historical underestimation of policy persistence, combined with heavily underfunded legacy corporate financial reserves. Original mathematical pricing models from past decades confidently assumed a standard 4% to 5% annual voluntary dropout rate among senior consumers. However, when actual real-world lapse rates unexpectedly fell under 1%, massive insurance conglomerates realized their long-term financial liabilities were skyrocketing. To salvage their profit margins, these corporate giants pivoted toward aggressive rate stabilization filings to systematically force older policyholders out of the system. By strategically driving up annual costs, insurers successfully convert decades of accumulated premium payments directly into pure, unclaimable corporate profit. The system operates exactly like an economic asymmetric escalator, designed to exploit your psychological desire for long-term estate asset protection. The initial financial barrier to entry is intentionally made low and highly appealing to catch your attention and secure your signatures. However, as you age and move further up the mechanism, the financial weight of compounding premium increases multiplies exponentially every single year. This ruthless compounding design ensures that only the ultra-wealthy can maintain their financial footing until reaching the final destination. The predatory industry capitalization strategy thrives by explicitly exploiting your inherent status quo bias and deep-rooted human loss aversion. Consumers continuously force themselves to pay initial premium hikes because they are desperate to save their substantial historical investments from vanishing. But when those premium increases compound by 50% to 100% in their late 70s, the immediate financial pain overpowers all logic. The intense economic pressure forces an immediate, panic-driven cancellation, completely destroying decades of careful financial planning in a single second. This sudden cancellation transfers 100% of your historical assets directly to the insurer's bottom line, leaving you completely unprotected when you need it most. Unlocking the hidden psychological mechanics of these corporate asset systems is your primary shield against systemic financial erosion. Secure your permanent seat in our advanced financial intelligence network by subscribing right now, ensuring your long-term estate planning remains entirely unassailable. To master retirement wealth management, you must look beyond the deceptive marketing brochures and analyze the structural reality of senior asset shelter mechanisms. Sophisticated consumers avoid traditional standalone pitfalls by utilizing advanced estate asset protection frameworks that prevent predatory corporate rate stabilization filings from draining family wealth. By understanding how the elder care security market operates, you can implement an environmental default switch that legally locks in your hard-earned equity. Let us expose the real-world numbers of these conflicting retirement profiles to see exactly how you can insulate your legacy starting tomorrow morning. A rigorous macroeconomic review contrasting 2 distinct retirement profiles over a 25-year horizon highlights the devastating reality of this systemic structural flaw. Profile A invests exactly $4,000 annually into a traditional legacy long-term care policy, confidently believing their future healthcare expenses are completely secured. However, upon reaching age 78, they face a catastrophic 120% cumulative premium hike that completely shatters their fixed retirement budget. This sudden financial weight forces a complete policy lapse, resulting in a net asset value of zero and erasing 2 decades of hard-earned equity. Conversely, Profile B redirects the exact same capital into a modern asset-based hybrid annuity policy designed to prevent voluntary surrender. This hybrid allocation preserves the foundational principle, providing an unassailable asset structure that ensures a guaranteed death benefit for their heirs. The accumulated family wealth remains entirely protected within this modern asset vehicle, even if no medical claims are ever filed. Examining the embedded infographic layout clearly demonstrates how a single tactical pivot completely changes your lifelong wealth protection trajectory. The left column represents the traditional long-term care policy, which completely dissolves into a red warning zone under escalating premium hikes. Meanwhile, the right column shows a steady green upward trajectory, highlighting how asset-linked defensive allocation safeguards your hard-earned capital. Traditional insurance conglomerates deliberately count on you following the path of Profile A to absorb your wealth into their balance sheets. They capitalize on your natural loss aversion, knowing you will endure multiple initial rate hikes before the final crushing increase forces cancellation. Breaking free from this calculated corporate framework requires moving away from outdated standalone products towards specialized wealth management tools. When you transition to an asset-backed vehicle, your recurring premium payments are never lost, but are instead retained as underlying home equity. This strategic shift ensures that your long-term care strategy operates as an authentic senior asset shelter rather than a corporate profit generator. To defend your retirement legacy from predatory systems, you must immediately implement a scientific asset management life hack called asset-linked defensive allocation. This advanced method involves establishing an unalterable asset-backed hybrid vehicle that legally guarantees a full return of premium features under all market conditions. Alternatively, utilizing specialized, irrevocable asset protection trusts completely shields your family wealth from predatory systemic rate hikes and external corporate liabilities. By creating this environmental default switch, you successfully eliminate the psychological vulnerability that insurance pricing models are specifically designed to exploit. Before another unexpected premium statement arrives in your mailbox, you must take immediate control of your policy's historical trajectory. Conducting a rigorous personal audit of your current provider's historical rate increase patterns reveals exactly when the next compounding spike will hit. Your immediate tomorrow morning action step is to formally demand a comprehensive reduced paid-up benefit option directly from your current provider. This critical legal request ensures you permanently lock in your existing equity without paying another single dollar in escalated corporate premiums. Refusing to let your multi-decade investments convert into pure corporate profit is the ultimate upgrade to your personal financial intelligence network. Secure your estate asset protection frameworks immediately, eliminate systemic financial erosion, and permanently insulate your family wealth starting tomorrow morning.